Hey guys, how's it going? It's Andy from MagooInvesting. Happy Wednesday. I desperately need to get a haircut, and hopefully I'll have that figured out by the next time I make a video on Friday. We are now into September, and it really seems like Mother Nature just kind of flipped a switch. I woke up to go to the gym at like 5:30 this morning, got into my car, and had to defrost my windshield for the first time. And so I'm really excited for fall to happen, but that means that we're going to be switching into the later parts of the year, which have historically, some months have not done as well for the overall stock market. So in today's video, I wanted to talk about a major change that we saw in the stock market starting on Monday that I think could be a huge problem going forward. And I'm going to discuss some of the implications of this change and how I'm going to be protecting myself going forward. Most of the problems start from the stock splits that we saw on Monday with Apple and Tesla. And on the surface, it seems pretty simple. Just the stocks split in price, they became cheaper, and there are more shares available. Doesn't seem like it would change that much. However, I'm going to be talking about why these changes are pretty big overall, and I think it's going to be really interesting to see how this affects things going forward. Before getting into today's topic, I do have to say that I'm not a licensed financial advisor, and this is not financial advice. Anything you hear in this video is just me giving my own opinions on the stock market, and you need to do your own research. Also, if you've been enjoying these videos, really appreciate it if you hit the like and subscribe button, as it would help my channel out a lot. With that out of the way, let's get into today's topic about why I'm a little bit worried about the overall stock market. So on paper, these splits that we saw on Monday with Apple and Tesla seem pretty straightforward. They just became cheaper, and we've seen an influx of retail traders that have been flocking to both Apple and Tesla since that stock split happened on Monday, and both of these stocks are up significantly since that happened. And so it becomes very interesting because these changes in price don't really change anything from what we've seen. I've talked in plenty of videos about how the stock market is the most accessible it's ever been. And with a stock split, it's not that different than what we've seen in the past. For most of these major brokers, you're able to buy fractional shares. So the price of an overall stock isn't really the deciding factor on accessibility. This doesn't really change that much besides the overall appeal of seeing a cheaper value for a stock like Tesla that used to be over $2,000. However, this change does have a major implication to one of the indices that I look at commonly. When people look at the overall stock market, they look at 3 of the indices to kind of determine what happened during that day. They look at the Dow Jones, which is 30 of the largest stocks. They look at the Nasdaq 100, which is a tech-heavy index. And then look at the S&P 500, which is 505 of the largest companies. And I think it makes up around 80% of the overall market cap for the stock market. So for the Nasdaq and S&P 500, these indices are weighted by market cap. So the larger a company is overall for market cap, which is share price times the number of shares available, that means that a stock that has a higher market cap will influence the S&P or the Nasdaq more than a smaller company. However, when you look at the Dow Jones, they do it a very different way. The Dow Jones has been around for a long time, and their historical way of determining the price of the Dow Jones has been based off of the actual price of the stock, meaning a stock that has a higher price gets a higher weighting on the Dow Jones compared to a smaller one. So when you look at Apple, which is a member of the Dow Jones, as a stock split, it went from being the most important stock on the Dow Jones to being pretty much middle of the pack. But then when you look at what happened to it for the Nasdaq and the S&P, nothing changes because while the stock price went down by a factor of 4, the number of shares outstanding increased by a factor of 4. So there was no change for that. But for the Dow Jones, the weight of Apple shrank by 75%, which is really interesting. And so why is this a big deal? Well, it's a pretty nice thing when your largest weighted company has been doing incredibly well. When you look at Apple, it's up 80% so far in 2020, and you just made it so that it's no longer the largest part of your index. And so now you have the new king, which is going to be United Health, ticker symbol UNH, and UNH is only up 6% in 2020. So it's a real hit to the potential of the Dow Jones because you have this top performer in the overall stock market that is not as important overall. And you had some recent shakeups where they removed Raytheon, ExxonMobil, and Pfizer, and then they replaced it with Salesforce, Amgen, and Honeywell. And so you have a very different cast when it comes to the Dow Jones. And so it's very different than what we've seen in the past. It is pretty common. It happens every couple years where you have a switch up in the Dow Jones to have a more better representation of the overall market. But I think it's really interesting that when you have the most important stock for the Nasdaq and the S&P, which was the most important stock for the Dow Jones, it is no longer the case. So now I want to talk about why I think this is potentially a problem. And I don't just have a problem with the way that the Dow Jones weights their index. I have a problem with the S&P and the Nasdaq as well. Overall, when I look at the price weighting, it doesn't make any sense to me at all. I have no idea why they determined that price should be the determining factor for how important a stock is. There's some really interesting examples of some of these companies that really don't show how the economy is doing. Maybe something like a Domino's pizza that's relatively expensive, but does not really show what's going on overall. And for some reason, they've kind of kept this as tradition. And so it's not a great determining factor of gauging the overall market. And then you go to the Nasdaq and S&P 500, which are cap weighted, meaning that the larger market cap you have, the more important you're going to be overall. And so Apple, you have the $2 trillion companies, which are very important overall. But we've seen some interesting trends where the top 5 companies, which are going to be Amazon, Apple, Microsoft, Google, and Facebook, now make up 25% of the S&P 500's weight, which is the largest amount that we've seen in a long time. Even going back to the dot-com bubble of around 2000, the top 5 stocks, which were ExxonMobil, which just got removed from the Dow Jones because it's no longer as relevant, that only made up 18% of the overall weight of the S&P 500. So this is very large. And so the two main problems I have with these weights is that, number one, you really don't get a good representation of the overall stock market and the health of the economy. When you look at the stock market, you can see that stocks are up overall this year if you look at the Nasdaq and the S&P. Is that a representation of the overall market? Probably not. At this point, there are plenty of stocks that are down significantly in 2020. More specifically, I think of energy, travel, and the financial stocks. But since all of these tech stocks make up a significant portion of the weighting, they've done incredibly well. You have Apple that's up 80%, you have Amazon that's up in the 60s, and then Microsoft is up more than 40%. And these are pulling up the rest of the market. And so as we've gotten this influx of new investors as the lockdown started, we've seen all the data of how many new retail investors there are. And it kind of seems like they're just flocking to the tech stocks because, one, they're doing well, and they're kind of familiar compared to, when you look at the Dow Jones stocks, there's a lot of stocks in there that aren't as familiar to the everyday consumer. And so these tech stocks are pushing up the rest of the market, and it makes these new investors feel like the overall market is in a great spot. But we have a massive divide between tech stocks and the rest of the overall market. And so I think this is one of the potential factors that is leading to a potential bubble. You have this unrealistic expectation of the health of the overall market, and it just keeps getting pushed up. And eventually that might burst. We really don't know what's going to happen, but at this point, I think that's one of the factors that's leading to a potential bubble. And then number two reason I don't like this and why I think it's a problem is that any major news that would affect these top 5 stocks is going to hurt the overall market significantly. One of the events that I thought could be a bad thing would be, we've seen some stuff about a TikTok deal potentially not going through. However, I'm like 95% sure it will go through eventually. But looking forward, I don't have a date set on the calendar where I'm like, oh yeah, this is going to be horrible. They've done very well during earnings for the past 6 months, so I'm not worried about that. But any big news could push them down significantly considering how overextended they are right now. And for someone like myself that's not as heavily invested in these major stocks, something like a Sonos, which I think is in a great spot as a company, there's no way that Sonos is going to be able to hold its own because it's so small compared to these tech giants. So if Apple gets hit with some bad news and it falls 4%, pulls down the rest of the market, Sonos is going to go with it because it's not strong enough to hold up against that news. So overall, what am I doing to try to protect myself from what I'm seeing right now? The main thing is I'm looking at ways to protect myself by buying into these sectors that have been beaten down. When you look at the tech industry, they're all up significantly in 2020. And so when that bubble does burst, the tech stocks are going to give back a significant portion of their gains. So at this point, that's why in these past videos, I have not been talking a lot about tech stocks as being a great investment at this point, because I really think it's a huge risk. I don't think it's worth it. So the places that I'm looking are the beaten down sectors. And so I'm doing a lot of research into the energy sector, which is not something that I know a lot about. But if these tech stocks do burst the bubble, I don't think energy, travel, or the financial stocks are going to be hit worse than what we saw so far in 2020. They may retest the lows from mid-March from the pandemic, but I don't see them going much lower than that. Compare that to something like an Apple, it's up 80% in 2020. There's plenty of gains to be given back. And so that's why I'm looking for these safer stocks that on paper, if you compare them to the returns that they've seen in 2020, don't look safe. But when I think of the downside risk, I think of these beaten down stocks as being safer in that aspect. So at this point, I don't know what's going to happen with the overall market. It does seem like a bubble is forming, and I'm trying to figure out ways where I can try to protect my portfolio. I've made a significant amount, almost around 35% at this point, and I'm trying to lock in those profits. But there's also the risk that you sell, get out of the market, and things just keep going up. That's what we've seen so far in 2020. I have been talking about a potential bubble forming for like 4 months at this point. But when it does happen, if it does burst, I feel like it's going to be very violent, and I'm very curious to see what happens. So let me know what you guys think of this potential problem, or what I've identified as a problem, with the weighting for the Dow Jones and with the Nasdaq and S&P. And let me know how you're protecting your portfolio going forward in the comment section down below. Thanks for watching. I appreciate all the support, and I will see you on Friday.